Hey everybody, Preston Brent here with our Trader User Group Weekly Roundup. This is for the trading week ending September 15th, 2017. What I've got on the screen here is the S&P 500 E-mini futures. Before I jump into it though, we finished at all-time highs yesterday. Yesterday we also had headline CPI data coming out for the United States. We saw that it was up about 40 basis points from the previous month. That's 0.4%. And it made it the biggest monthly gain since January of this year. It also boosted year-over-year comparison to about 1.9%, which is just shy of the Federal Reserve's target inflation rate of 2%. Now, one of the biggest reasons given for the jump, of course, in the monthly gain in the CPI was the price of gasoline. So we know that Hurricane Harvey busting into Eastern Texas was a big culprit of driving up gasoline prices with refineries shutting down for a bit, and it caused gas to move higher, oil to move lower, which for our user group, we were looking at crack spreads or reverse crack spreads. It turned out to be, for those that took the trade, a really interesting trade, but we had the headline inflation number year-over-year comparison move up. Now, it's interesting that the Feds don't include energy in their inflation number, but it still moved up. So the futures market bumped up the expectation for a Fed rate hike before the end of this year from 30% to about 50%, which sounds about right to me. We get Janet Yellen, aka Aunt B, coming out next Wednesday. She's going to belly up to the podium and give us a press conference, as she always does, or as the Fed chair always does at the end of every quarter, and we're going to hear what they want. The markets want to know just kind of where she is with any potential Fed rate hike. So it's a 50-50 shot right now, according to the 30-day Fed Fund futures. But that tended to boost interest rates or buying yields as to the CPI data coming out the way it did. So it's going to be real interesting to see what they do. Now, also, we got the Bank of England, and they bumped their inflation up dramatically. Now, for our user group, our traders, and our secret trader, I've been talking about going long the pound for a while, and we're taking advantage of that, and we're making good money. So in our secret trader, we've got some really interesting trades that are working out very nicely for us. But Bank of England, they've come out after they didn't hike their rates. It was a 7-2 vote not to hike their rates this past Thursday. But they're now coming out and saying they're going to be forced probably to take some of the drain their money reserves floating around in the market there in Britain. So we saw the British pound move up very high. And of course, it was not a surprise to us because I've been, pounding the table on the British pound for quite some time. So let's take a look at where I'm seeing the markets at this point, and just kind of how things are shaping up. Like I said, surprisingly, the S&P 500 E-mini futures closed right near all-time highs. The markets closed at Friday right at 2,500, right on the button, which I find that fascinating here. You can see right at that area there, 2,500. The all-time highs are slightly above that. You can see this trend line moving up like that, which we're following our group. And I had said that short of any geopolitical risk, the markets are going to move higher. I know everybody is on the other side of the boat saying the markets are way too high for where they are, too high, rich valuations, all these other things. And I would probably fundamentally agree with everything that you just said. And we're on the third longest secular bull market in the history. That was officially noticed this past week. It's now official, third longest bull run in U.S. history. So generally, when you get on a bull run that's been long like this, you start to get a lot of bears start to come out of hibernation and say, well, it's about time that we see a big drop. And given corporate profits in Q1, then Q2, and the forward guidance in Q3, short of any geopolitical event, markets want to climb higher. Now, all of this is without any tax cuts baked into the prices. If the Trump administration can get any tax cuts through, if the infrastructure spending bill gets done, if any repatriation of money from U.S. corporations comes back here onshore from offshore, the markets can continue the run. There's only really one fly in the soup here, so to speak, but it's really a big horsefly. And I guess you guys probably know what that is, the geopolitical event in the Korean Peninsula. That would be North Korea. Of course, they fired a missile last week, and if you guys will note, the markets kind of yawned. Yeah, they went down about 5 or 6 points once the markets opened on the day that they fired the missile. That would be Thursday. But then the markets kind of worked their way through it and then closed higher for the end of the week. You know, it seems like the markets are getting used to that little fat ding-dong eating ho-ho freak in North Korea. But there is still an inherent risk there. People are being backed into corners. What do I mean by that? Well, the U.S. basically is saying they're not going to tolerate a nuclear armed North Korea. And you could probably argue that, well, they're already nuclear because they've tested some. But then the issue of putting it on a warhead and launching that warhead and then having it survive reentry and then guidance systems and then it exploding are a completely different animal. So they may not be there yet. But the U.S. is already on record. Trump administration's on record saying he's not going to allow that to happen. Meanwhile, the Chinese don't seem to be fully backing everything that the U.S. wants to do. So this end of this week, Munchin, the Mooney Treasury Secretary, came out and threatened China by saying he threatened to cut off any Chinese access to the U.S. dollar payment systems if China doesn't really rigorously enforce new UN sanctions. And so this is going to be a really interesting because China has not really been on board with that. And the U.S. dollar, just as a reminder, represents about 60% of the global U.S. reserves, and 80% of global payments are done in U.S. dollar. And almost 100%, but not quite, of global oil sales are done in the U.S. dollar. And yes, China and other Asian countries, including Russia, are trying to work out ways to do payments in rubles and yuan, but the dollar is still the king of the jungle when it comes to global payments. And I'll remind you that China owns about 6 or 7% of the U.S. 20 trillion in debt that we have on our balance sheet. So if we really go out there and start to punish China, China has about $1 trillion of government securities that are in reserve. So, and they roll over a lot of these every year. And if China's denied access to this, you know, effectively freeze them out, it's going to put a world of hurt on China because they're using that rolling reserve there to help their banking system and to defend their currency. So if we do that, that would be our nuclear option with China. The implications of freezing out China and those dollar payments are just unbelievable because China then would come back and hurt us with the debt that they hold from the U.S. It would be very, very, very painful for the U.S. dollar system as well. So just remember, for every action, there is a reaction. So China is relying on these liquid dollar reserves to bail out their almost insolvent banking system. They've been doing this for a while. And they've been defending their own currency. So we freeze them out, then the U.S. gets punished dramatically as a result of that. And so the path is really set for North Korea. And that's why I believe the markets have not really priced in a shooting war with North Korea like they should. So there is this huge geopolitical risk. Now, I went through this whole diatribe to explain to you just what's at stake here. We've got a great market short of North Korea and that ding-dong, ho-ho eating freak in North Korea. Short of that, I believe the markets are going to continue to rise, you know, with in our view, I've been saying these are buy the dip moments, and that's just the way we've been treating them. But all it takes is we shoot down a missile or any kind of fisticuffs breakout, and we're going to go lock limit down, which is about a 5% move in overnight hours and a 7% move while the markets are trading. Okay. And you do the math, but that's about $120, $130 or 130 points immediately, 150 points in the E-minis. And we'll be there before you have a chance to do anything. So that's why in our secret trading with our members, we're adjusting some of our trades, at least through the next, I see a window here of about 90 to 120 days, where if all hell breaks loose, that's when it's going to happen. And it's not going to happen, guys, during market hours. It'll happen Saturday night. And then you'll go to look at the markets Sunday night when they open, or Monday morning, and you'll see that everything is frozen, lock limit down, and your trade that you'd spent 3 months working on that's got nice profits is underwater dramatically. So you've got to be hedging. For our members, we're going through ways to hedge, whether you've got a portfolio margined account or you got a non-portfolio margined account. So these are just some of the things that are on my mind. Short of that, this is the market. We're in this buy the dip, right? And I think this can stay here for a while. We're in a mode here where we may see another dip coming up, right? You see these rounded turns like this. So we're right at that point where, the symmetry of the market move means we're probably ready for another dip coming back down to the bottom of this trend line, which would put us right at about this 200% fib node measured off the former all-time highs in the summer, July of 2015, and the lows that were made February of 2016. So these are where the markets are right now, and this is what we're doing. We're having another great year with our user group and our secret trader. For those of you that like what we're doing, like what I'm doing, we're coming out with a huge options university, options academy. Get your master's in options education. That's going to be starting probably the first week in October, every Thursday evening for about 3 or 4 months. And it's all going to be recorded. Over 100 hours of not just here's a strategy, here's what it means, but we're going to talk about how to trade that strategy based on the market environment. So I highly encourage you to watch for that email. It's something that I think you'll find useful. Our members get 60 or 70% off. If you're a non-member, then I'd still highly recommend and encourage you to take us up and join that process. So be on the lookout for that email coming up. So this is where we are with the S&P 500 E-mini futures. If I put all the drawings on the screen, you can see all the key levels. Let me just take it off for a second. You can also see, and this goes back to the election, but you can see all of these volume over price areas. These are areas where there is a lot of buyers underneath the market willing to hold the market at that level. Okay, and you could see they just also happen to be at the levels where we encountered a lot of support, and again, not surprising. And if we come back down like this, seeing us at the fib extension there of around 2465 down to about 2440 would be just another buy the dip moment, short of anything happening, short of fisticuffs happening over in the North Korean peninsula. So if I put everything back on the screen, you can see where we're sitting right now. There is not any divergences down here in the MACD. Every time we move higher with these peaks, without getting these divergences, and that just says that any peel back is going to be a buy the dip kind of moment, which is kind of where we've been since March of this year. Okay, so that is and again, all-time highs on Friday with the S&P 500. So it's just kind of where we're sitting. If I put it on a 2-hour chart, which is a weekly swing chart time frame here, all right, you can see right here we actually came right up and hit it all-time highs. We're setting up for a little bit of a divergence. We got a 3, 4, 5 pattern. So a little bit, and this is part of the dip mode, right? So we've got this 3, 4, 5 pattern. We're going to be setting up for a divergence. It's a poor man's bed. Nonetheless, it's still a bed, which means we'll probably pull back just a little bit. Wouldn't be surprised to start the week off that way. By the way, we finished this past week. It was triple witching. Futures expiring, going out to the quarterlies, going out, monthlies expiring. So we had a number of the E-minis moving out to the next quarterly cycle. Typically in a triple witching, the markets just want to grind higher and vol moves lower, which is what we got. And then the week following a triple witching, you get a little bit of a resting period in the market. So I wouldn't be surprised to see us start off that way. We may continue the momentum into Monday and then just kind of a resting period, but that would be the way I would look at it and the way I would see it. Okay. And you can also see Nasdaq. Excuse me. If we look at Nasdaq, you can see Nasdaq also didn't quite make their all-time highs, but is bouncing off the all-time highs. We got a bearish diversion set up here on this one, a poor man's bed, which would suggest a little bit of weakness we can expect. Dow, you can see also on the Dow, all-time highs on Friday, 22,235. A little bit of a bearish divergence set up here as well. So a little bit of weakness down to the 50 EMA. You can see where it's provided support. So all of the markets are suggesting, and then at the Russell, which is the weakest of the batch, nowhere near the all-time highs, but it's cleared the hurdle of the 200 and the 50 EMA. In fact, we may see a little bit more strength out of the Russell this week than we would out of the other markets. But that is kind of where I'm looking at the indexes at this point in time. Okay, and of course, if we look at the VIX and where we finished the VIX for the week, 1017, we're back down. We're still in the green. We're down here, very low levels. We're in zone 1 as far as the range of VIX, which dictates certain types of option strategies versus others. And when we get down here, the existential risk of moving us back up into zone 2 increases. So we've just got to be very careful. But again, the markets had a really good, strong finish to this triple witching. Okay. And then, of course, if we look over, as I said, and look at the Treasury and the bond yields, they were flat for the day. You can see, though, how they've been backing off just a little bit. We're at a 50% shot at the Feds hiking the rates before the end of the year. This is where we're sitting right now. But it's still in the up mode, right? I mean, if you look at January of this year for where the bond started, in fact, if I were to draw in the year, this is the year right here, okay? We kicked off the year right about here, and this is where we're sitting now. So we've had, although it's jagged, we're still in an up mode. The vector is pointing up for the year. All right. After the dip in March, we've just been moving higher because the belief is with inflation not going anywhere, the Feds will not be able to raise the rates. And in a Machiavellian sort of way, they don't include gasoline and energy in their inflationary guidelines, yet that's what drove the CPI data higher on Friday. So let's see what they do. 50-50 shot. Everybody's going to be listening to Yellen more so this time next week on how she's going to reduce, what she's going to do with her BS strategy. I call it the balance sheet strategy, but I call it the BS strategy. Let's see what they do. And then, of course, it'll be complicated if we threaten China and take them out of the U.S. dollar system. That'll be a catastrophe, not only for China, but for the U.S. as well. So there's going to be some really interesting plays coming up over the next 90 to 120 days that can jack up VIX well over 30. You've got to be careful here, folks. You've got to be hedged. The markets want to go higher, but it's not going to take a lot to create this geopolitical risk over in the Asia Pacific area. Look at the currencies. Look at the British pound. This is what I've been talking about. We actually busted a move higher. I didn't even have a chance to do it, but look at that right there. Boom, away we went. You can see here, we've been in this. It's been a buy the dip. Any time the pound has dipped this year, and this is the kind of the attitude we've had. I've had anyway. And I just said this is a wonderful opportunity to get long the pound, especially, you know, when I've been talking about these are buy moments down here. Well, we got long in our secret trader and we're riding it, and it's just a great trade. All right. I mean, look at that 1.36. We haven't been that high in quite some time, right? And I think it's going to go even higher. It's going to not with any. It's going to be a little bit rough. We're going to have these dips, right, in the British pound, and it's going to be headline risk kind of dips. Every time they come out and say they couldn't do this or they couldn't do that, the pound is going to come back down. But that's where I think the pound is going to end up sometime in 2018, a little bit around the $1.50 area. And you know, this is just where I see everything taking place. This was the Brexit vote. And I think it's going to get back, and you can see this wide range for the Brexit vote, all the way down from about $1.40 up to 1.47. And heck, we're almost there now. We're at $1.36, right? You know, so we're up near this wider target range right now. But we're going to have some more dips, guys. But this is just, I think, a really great trade. I've been talking about it for 3 months now. And we're going to continue to play it and extract money from it. There are a number of other trades we're doing that in the equity world, which I'm not going to go through here for our members. I'm going to go through tomorrow night in our weekly market watch. We'll go through these as well in our secret trader. But this is kind of where the pound is. If we come over and look at gold, gold is doing what I said it would do, which is going to pull back. I'm looking for it to pull back to the 1300. If Yellen is more hawkish, you're going to see gold pull back into this upsloping channel, probably settle in around the 1300 area. Gold hates a hawkish Fed. They hate higher interest rates, and it hates rising inflation. All right. Those things just don't mix well with gold, as well as a stronger dollar. One of the things boosting gold is the dollar's just been so weak all year. I think I think gold is going to pull back a little bit, and then I think it'll create another buying opportunity. But I've been basically bullish gold, but not chasing it up at these levels here. And then, of course, oil, energy. We've done 17 trades in a row where we made money on oil. If you look at this chart here, we finally got a breakout in oil to the upside. Now the question is it going to hold this channel? Is it going to take out that prior pivot high right there? That's what we're challenging right now. You can see once we define the downsloping trend line, we couldn't get up above it. And I said that once it moves down, it's going to make another repeated run. And now it took it out. It took out the initial breakout, which is bullish. And now we're testing the prior pivot high. If we go sideways and then break out, we're going to move back up into this area right here. That's kind of where I see oil near term. Okay. So we've got a lot of successful trades in this. We're continuing to trade it in our secret traders. So that's a little bit about what we're seeing in oil. We got other things that we're looking at in the ag market, in the meat market, in the soft market. So we're all across the board, currencies, commodities, and equities. In our secret trader. If you're not a member, I highly encourage you to come in and check us out, folks. Be on the lookout next week for an email on the getting your master's in option education. We're going to go through that. I'm also going to include some things for portfolio margin, folks. We're going to go into gamma scalping. We're going to go into which is more of a day trading vehicle for folks. And we're going to go into trade adjustments, options on futures as well. So there's just, we're going to talk about ratios, pair trades. We're going to talk about the crack spread and some of these other fun things that you may not be able to see in other areas. So I highly encourage you to come in and check this. They'll all be recorded and viewable for you anytime. All right, everybody, that's kind of where we're sitting right now. Members, I will see you this Sunday night. Everybody else, have a great, wonderful weekend. Take care, folks. Ciao.